In financial markets, there is a paradox. On one side, we have a whole system built on liquidity. Continuous trading, real-time pricing, capital moving in seconds. But on the other side, there are trillions of dollars completely frozen. Real estate, private equity, private credit, assets that exist, that have value, but that you can sell or at least not quickly. And this creates a massive problem, because the wealth exists, but it can't move freely. But today, the biggest names in finance, from BlackRock to JPMorgan Chase, are trying to change that. And what's their plan? To turn these assets into something that can be traded, turning illiquid assets into liquid ones, using a technology that is already reshaping the financial industry, a process called tokenization.
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 We believe the next step going forward will be the tokenization of financial assets.
A technology that Wall Street considers a real game changer in the current financial services industry.
I think it's perhaps one of the biggest innovations in capital markets, certainly in recent history.
A process that is already happening today, not just for currencies, stocks, and other liquid financial assets, but increasingly for real-world assets, the ones that don't trade easily.
Industry insiders I have spoken with have said that eventually you will see the entire financial market run on blockchain.
And this isn't just a theory. According to multiple estimates, this market could reach trillions of dollars in the coming years.
I do believe we're just at the beginning of the tokenization of all assets.
But there is one fundamental question that we need to answer. Can these trillions actually be unlocked? Or is this just a promise that the system isn't ready to deliver? So before anything else, we need to understand where these trillions are locked up, and why Wall Street is so focused on making them liquid. The reality is, you see them every day all around you. Before anything else, they are stuck in real estate. They are in homes, in office buildings, in the shops down your street. They are not hidden, they are simply outside the markets we look at every day. On its own, this asset class is worth hundreds of trillions of dollars. To put the number into perspective, the entire global stock market is roughly a third of that. But think about it. If you own a house, how long would it take to sell it? You can't just sell a part of it. There is no sell button, you have to find a buyer, negotiate, wait for weeks and sometimes months. And that time between the moment you want to sell that investment and actually get the money is the difference between value and liquidity. And this is what an illiquid asset looks like. An asset that cannot be readily sold or exchanged for cash without a substantial loss in value. And this is just the beginning, because then there are private markets. Private equity funds, venture capital, private credit. Here we are talking about over $10 trillion globally. Investments historically reserved for institutional investors and high net worth individuals, typically accessed through closed-end funds and specialized investment vehicles. But here, the rules are even stricter. When you invest, you are agreeing to lock that money up for years. You can exit whenever you want from your investment. There is no continuous market, and while recent years have seen the rise of semi-liquid structures in these asset classes, illiquidity remains their defining feature, and often the most delicate one. But then there is something even bigger. Most companies in the world are not publicly listed. They don't have a price updating every second, they don't trade on a public market, and there is no single transparent price anyone can rely on. If you want to sell, you have to find someone willing to buy, and that can take months or years, and a series of complex processes of due diligence and valuation that requires the presence of expensive intermediaries. And finally, there is debt, a massive market over $100 trillion globally. On paper, it looks liquid, but in reality, it often isn't. Take corporate bonds for example. Many of them don't trade for days, not because they have no value, but because they are traded over the counter in fragmented markets where buyers and sellers don't always meet. And if you put all of these together, real estate, private markets, private companies, credit, what emerges isn't a niche, it's the largest part of the system. Most of the world's wealth is not liquid, and the part that does move is only a fraction. And this is where it gets interesting, because if even a small part of that value will become liquid, we are talking about trillions of dollars that could enter the markets, from which financial institutions can create a whole different level of revenues through commission, transaction fees, for example, capitalizing all the wealth that already exists. And this is not a small shift. This is something that could reshape the entire financial system. And that leads me to an inevitable question. So, how exactly do these large institutions plan to make all of this possible? This is where something called tokenization comes in. And to really understand what that means, we need to go one step deeper. Because this isn't just about digitizing an asset, it's about changing how it's owned and how it's traded. But let's start from the basics.
Tokenization solves a lot of problems. I mean, there's an efficiency aspect to it. You can have real-time settlement, lower fees, but maybe the most powerful part of it is just democratization of access to investment in high-quality product.
When we talk about tokenization, we are talking about the process that already has clear examples in the real world. Take stablecoins, for example. They are essentially digital version of a currency like the US dollar. Now, apply that same idea to something like a commercial building. Today, if you want to invest in this kind of assets in a traditional way, you either have to buy the whole building or invest in it through a fund that owns one or more properties, getting exposure to the specific building. With tokenization, something slightly different happens. The asset is placed inside a legal structure, typically an LLC, and the entity is then divided into many smaller home ownership units. Each of those units can be represented as a digital token. So, when you hold a token, you are not holding the building itself, you are holding a share in the entity that owns it. And that share gives you real economic exposure to the asset behind it. It could be a share of the cash flow from rents, a portion of ownership, or a claim of that asset. At that point, instead of selling the entire building, you can trade individual units. For example, you can sell 10% of your total investment with other investors. And that completely changes the mechanism, because we are turning a single, unique asset into something standardized. But we have to be clear here. This isn't something you couldn't do before. You can buy shares of an LLC holding an asset in a traditional way. But now, with tokenization, all of that is much easier and much faster. And the exact same principle applies also to private markets. Fund shares or stakes in private companies can be represented as tokens. But today, transferring those assets is anything but simple. A single transaction can involve multiple intermediaries: fund administrators, custodians, transfer agents, legal advisors, and often broker or placement agents. Each of them has to validate, record, and reconcile the transaction. Ownership needs to be updated, documents need to be processed, approvals need to be granted. And all of that takes time, sometimes days, sometimes weeks. And all of these intermediaries involved have big costs. With tokenization, the process can look very different. Ownership is represented directly by the token, so transferring the asset means transferring the token. No need to update multiple ledgers, no need to reconcile across different parties. The transaction becomes a single step, faster, more direct, and with fewer frictions. And when you put all of this together, you start to see what Wall Street is trying to do. Turn complex, unique, liquid assets into standardized units that can be traded more easily. And this is where we need to understand what are the benefits that come from this. The main ones are three. The first benefit of tokenization is the opportunity to fragment the asset. You no longer need to buy the whole asset, like a whole building, you can buy just a fraction of it. And the second main benefit is access. More investors can participate with smaller ticket sizes, accessing opportunities that were previously out of reach.
We're building this artificial intelligence. Most of the companies on the bleeding edge are private. And I think the best way we can make sure that it benefits all of humanity is to give people exposure to it.
And finally, the third benefit is continuity and price discovery. Assets that today trade rarely could now be traded continuously. And that's what makes them more liquid, and with a specific market price available 24/7. Given all of this, tokenization isn't just a new technology, it's a completely new infrastructure that enables a new way of making markets work. Up to this point, it all sounds like a theory, but the interesting part is that all of this is already happening. So let's start with a concrete example. A platform called Realty is already applying this model to real estate. Take a house in the United States. Instead of being sold to a single buyer, it's divided into hundreds, sometimes thousands of shares. Let's say 1,000 units, each one priced at just a few $100s. When you buy one of those units, you are not buying an abstract token. You are buying real economic exposure to that property. If the property is rented, rent is collected and distributed across all investors. You receive your share, proportional to how many units you hold. But the real shift is somewhere else. If you want to exit, you don't need to sell the entire property. You don't need to wait months to find a buyer. You just sell your units in the open market, almost like you would with a stock. In practice, you are turning a house into something that behaves like a financial asset. Now take it one step forward, and the same idea is being applied to high-end real estate. For example, the San Regis Aspen Resort, a luxury hotel in Colorado. Part of the ownership of the hotel has been turned into digital securities. Instead of being owned by a single investor or a closed group, ownership is divided into smaller pieces. This happens through platforms like Securitize. Investors were able to buy exposure without buying the entire asset. What used to require millions can now be accessed in smaller units. And it doesn't stop there. Think about something even less liquid. Take for example art. A multi-million-dollar painting, normally accessible to just a handful of buyers. Companies like Masterworks acquire these works and divide them into thousands of shares. So instead of one owner, you can have hundreds, even thousands, each one owning a fraction of the same underlying asset. Assets that used to be completely locked start to become accessible. And even private markets are starting to move in this direction. Firms like Hamilton Lane have begun experimenting with tokenized exposure, turning investments that were once locked for years into units that can, at least in theory, be transferred more easily. So the idea is real. It's already being tested across real estate, alternative assets, and private markets. But what we have to understand now is at what point of this major transformation are we? So this is where things stand today. The technology exists, it works, assets can be tokenized, they can be transferred, they can be traded. And the first major players from BlackRock to JPMorgan Chase are already in. But the reality when we talk about creating liquidity out of illiquid assets is different, because even if technology and example exist, there is not a market yet. Because a market, it's not just its technology, it's also participation. And today the data makes that very clear. Tokenized real-world assets today represent roughly $31 billion on-chain. But what's more interesting is how that value is distributed. Most of it is not in real estate, it's tokenized US treasuries, roughly $13 billion, followed by commodities like gold, with assets like tokenized gold already above $2 billion each. And to find real estate, we have to go down the list farther, still a very small portion of the total. So the irony is this: the assets we talk about the most are not the ones driving the market today. It's yield-generating assets, credit, treasuries, income-producing instruments, because they solve a simple problem first, where value is easier to price and demand already exists. And yet, even with this growth, the market is still extremely small, less than 0.003% of global financial assets. But to judge whether these markets are actually liquid, you have to look at the trading activity of these tokens. How much are they actually moving between investors? And this is where you run into a problem. There isn't much liquidity in these markets right now. Because most tokenized assets today are issued and then held, not actively traded. Academic research confirmed this. Low trading volumes, long holding periods, and very limited secondary activity, which means liquidity is still missing, not because the technology doesn't work, but because the market isn't there yet. Right now, tokenization seems to have created a different way of owning, but it's not effectively creating the liquidity that institutions are trying to create. And this is where everything comes down to two major conditions that need to be addressed in the years to come. The first is market participation. Because without enough buyers and sellers, there is no market, and without a market, liquidity never forms. But here is the interesting part. Participation is expected to grow significantly in the coming years. Institutional adoption is accelerating, with the major banks and asset managers already entering the space. And on the retail side, the number of blockchain users has already reached over 200 million active addresses globally, which means the potential participant base is already there. At the same time, multiple projections suggest that tokenized assets could grow from tens of billions today to trillions of dollars by the end of the decade, and that growth is driven by one thing above all: more participants entering the market. So now we come to the second major condition, fragmentation, because even when activity exists, it's spread across different platforms, different blockchains, different systems that don't connect. It's as if the money is trapped into separate silos, each one with its own rules, its own infrastructure, its own participants, and those silos don't communicate. So liquidity exists, but it's locked inside isolated pockets, and liquidity that is isolated is inefficient liquidity because it can meet, it can aggregate, it can scale. So liquidity doesn't just need to be created, it needs to be connected, it needs to be concentrated. Only then can a real market emerge, and only then can these assets actually move. Because what we are seeing today is not the final system, it's the early version of it. The infrastructure is being built, the assets are being tokenized, capital is starting to enter the space, but the market is still catching up. Wall Street already knows how to unlock these assets. Right now, it's building the infrastructure, testing the ground with asset classes where market participants feel more comfortable. The process is there, the technology exists, they already know how to tokenize real-world financial assets. But that's only half of the equation. The real challenge is making these tokenized assets move, making them as frictionless and liquid as traditional financial instruments, and that's a completely different story. Until that part is solved, those trillions of dollars will remain just out of reach for most people. And with that, we reach the end of this video. If you found it interesting, leave a like and subscribe to the channel. But before you leave in, I would like to ask you a question. Now that you know more about tokenization, would you invest in assets like real estate or private equity through tokenization, or would you still prefer traditional markets? Let me know in the comments. Until next time, from Vision Economy.